Look, something extraordinary is happening in the silver market right now, and if you're not paying attention, you're about to miss one of the most significant price moves we've seen in years. I'm talking about a gap up that could happen as early as Monday's open, and the signs are everywhere if you know where to look. Let me paint you a picture of what's unfolding. Right now, as I'm recording this, silver is trading just above $30 an ounce. But here's what most people don't understand. That price is about as real as a $3 bill. The physical market and the paper market have completely divorced from each other. And when that happens, when that disconnect becomes too wide, the market has a way of violently snapping back to reality. I've been watching the silver market for over 2 decades, and I've never seen the setup quite like this. The last time we had conditions even remotely similar was back in early 2011, right before silver went from $30 to nearly $50 in just a matter of weeks. But this time the fundamentals are even stronger, the supply situation is even tighter, and the monetary backdrop is even more favorable. Let me show you exactly what I'm seeing, because this isn't speculation. This is reading the market's own language, understanding what the big players are doing while everyone else is distracted. First, let's talk about what's happening in the physical market, because this is where the real story begins. Dealers across the United States are reporting something they haven't seen in years. Premiums on physical silver are exploding. We're not talking about $1 or $2 over spot. We're talking about premiums of $5, $6, even $7 per ounce on basic silver eagles and rounds. When I called 3 major dealers yesterday, all 3 told me the same thing. They're struggling to keep inventory, and when they do get shipments, they're gone within hours. Now you might think, okay, so retail demand is strong, so what? But here's what makes this different. This isn't just mom and pop investors buying a few coins. The U.S. Mint reported that Silver Eagle sales in November hit levels we haven't seen since the pandemic panic of 2020. They sold over 4.2 million ounces in a single month. But here's the kicker. They've already announced production constraints for December. They literally cannot keep up with demand. And it's not just the United States. The Perth Mint in Australia, one of the largest silver refiners in the world, has extended delivery times to 8 to 12 weeks for bulk orders. 8 to 12 weeks. In a normal market, you're talking about days, maybe a couple of weeks at most. When you see delivery times stretching out like that, it tells you one thing. There's not enough physical metal to go around. But let's dig deeper, because the supply situation is even more critical than most people realize. Silver isn't like gold. Gold is primarily a monetary metal. It gets mined, refined, and then it sits in vaults. About 90% of all the gold ever mined still exists in some form. But silver gets consumed. It gets used up in industrial applications, and it's gone forever. Think about this. Every single smartphone has about 1/4 gram of silver in it. Every solar panel uses about 20 grams. Every electric vehicle uses between 25 to 50 grams, depending on the model. And here's the thing. As these technologies scale up, and they are scaling up dramatically, the industrial demand for silver is going through the roof. The Silver Institute just released their latest supply-demand report, and the numbers are staggering. We're looking at a structural deficit of over 200 million ounces this year. That means the world is consuming 200 million more ounces of silver than it's producing. And this isn't a one-year anomaly. We've been in deficit for 3 consecutive years now, and the deficit is getting wider, not narrower. Now you might ask, if we're in such a massive deficit, where's the silver coming from? Great question. It's coming from above-ground stockpiles, from vaults, from existing inventory. But here's the problem. Those stockpiles aren't infinite. The COMEX, which is the major exchange where silver futures are traded, has seen its registered silver inventory, that's the silver that's actually available for delivery, drop by over 40% in the last 18 months. We're talking about going from over 150 million ounces down to under 90 million ounces. Let me put that in perspective. At current rates of industrial demand alone, not even counting investment demand, that entire COMEX registered inventory would be consumed in less than 4 months. 4 months. And that's assuming no one wants to take delivery of their futures contracts, which, as we're seeing, more and more people do. Here's where it gets really interesting. The big banks, the ones who have been shorting silver for years, are in a position they haven't been in before. JP Morgan, who paid nearly $1 billion in fines for manipulating the silver market, has quietly accumulated one of the largest physical silver positions in history. We're talking about somewhere between 800 million to 1 billion ounces of physical silver. Why would they do that if they thought the price was going down? They wouldn't. They're doing it because they know what's coming. They've been on the short side of the paper market, suppressing the price, while simultaneously accumulating massive amounts of physical metal. It's the ultimate trade. Keep the price low while you're buying, then let it run once you're positioned. And all the signs suggest they're done accumulating. Look at the commitment of traders report from last week. Commercial traders, which include the big banks, have reduced their short positions to levels we haven't seen in over 5 years. When the commercials, who are usually short silver, start covering their shorts, that's not a small signal. That's a flashing red alarm that something big is about to happen. But let's talk about the monetary side of this equation, because this is where silver's dual nature as both an industrial and monetary metal creates a perfect storm. Central banks around the world have been buying gold at record pace, over 1,000 tons in 2023, and they're on track to exceed that in 2024. But here's what most people miss. When central banks buy gold, it sends a signal to the broader market about the health of fiat currencies. And when investors start questioning fiat currencies, they don't just buy gold, they buy silver too, because silver is gold's more affordable little brother. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting around 85 to 1. Historically, that ratio has averaged closer to 60 to 1, and there have been periods where it's dropped all the way down to 30 to 1. If silver just reverts to its historical average ratio with gold at current gold prices, we're talking about silver at $42 an ounce. If it goes to the lower end of its historical range, we're talking about $80 to $90 silver. Now, I know what some of you are thinking. That sounds too good to be true. Silver's been disappointing for years. And you're right to be skeptical. Silver has been the most frustrating investment for the better part of a decade. But here's the thing about silver. When it moves, it doesn't move gradually. It gaps. It explodes. It goes vertical in ways that make gold's moves look tame by comparison. Let me take you back to 2011 for a moment, because understanding what happened then helps us understand what's about to happen now. In January 2011, silver was trading around $30 an ounce, right about where it is today. By April, just 3 months later, it had hit $49. That's a 63% gain in 90 days. But here's what's important. It didn't move in a straight line. It gapped up repeatedly, sometimes jumping $2 or $3 overnight, leaving short sellers scrambling and late buyers chasing. What caused that move? A combination of factors remarkably similar to what we're seeing today. You had a supply deficit, you had strong industrial demand, you had concerns about currency debasement after the 2008 financial crisis, and you had a massive short squeeze as hedge funds and banks who had been betting against silver suddenly had to cover their positions. But here's why this setup is even better than 2011. Back then, the world wasn't transitioning to electric vehicles. Solar energy was a fraction of what it is today. The green energy revolution, which is incredibly silver-intensive, was barely getting started. Today, governments around the world have committed trillions of dollars to green energy initiatives, and every single one of those initiatives requires massive amounts of silver. The Biden administration's Inflation Reduction Act alone is directing hundreds of billions towards solar energy. The European Union's Green Deal is even larger. China, which is the world's largest solar panel manufacturer, is expanding production capacity at a rate that will require an additional 150 million ounces of silver annually by 2030. Where's that silver going to come from? There's only one answer: higher prices to incentivize more production and more recycling. But here's the catch. Silver production doesn't respond quickly to price signals. It's not like you can just flip a switch and produce more silver. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. So even if silver prices double, you're not going to see a massive increase in supply unless the prices of those other metals also rise enough to justify opening new mines. And opening a new mine? That's a 7 to 10 year process from discovery to production. Now, let me share something with you that I think is really important, especially if you're someone who's thinking about retirement, about protecting your wealth for the long term. I put together a free guide on how gold IRAs work. It's in the description below. If you're sitting on $100,000 or more in retirement accounts, this guide covers how you can get physical precious metals into your retirement account without tax penalties. It's worth checking out if that's relevant to your situation, because what we're talking about here isn't just about making a quick trade. It's about positioning yourself for a fundamental shift in how wealth is preserved. All right, back to why Monday could be the day everything changes. There are several catalysts converging right now that could trigger this gap up. First, we've got the Federal Reserve meeting next week. The market is pricing in potential rate cuts in 2025, and every time the Fed signals easier monetary policy, precious metals rally. Why? Because easier money means more currency debasement, and silver is one of the best hedges against currency debasement. Second, we're seeing unprecedented demand from India and China. India, which is traditionally a massive gold buyer, has seen silver imports surge by over 150% year over year. Chinese investors, who are dealing with a collapsing real estate market and a weakening yuan, are piling into precious metals as a safe haven. When you combine Western investment demand with Eastern demand, you create a global buying wave that's impossible to suppress. Third, and this is crucial, we're heading into a period of seasonal strength for silver. Historically, silver performs best in the first quarter of the year. January and February are typically strong months as new investment money flows into the market and industrial buyers restock inventory. If we're already seeing tight supply conditions in December, imagine what happens when January buying kicks in. But here's the technical setup that really has me convinced a gap up is imminent. Silver has been consolidating in a tight range between $29 and $32 for the past several weeks. In technical analysis, when you see a tight consolidation like this after a strong move up, and remember, silver is up about 50% from its lows earlier this year, it's usually a continuation pattern. It's the market coiling up, building energy for the next leg higher. The 50-day moving average has crossed above the 200-day moving average, which is what technicians call a golden cross. This is one of the most bullish technical signals you can get. The last time silver had a golden cross was in late 2010, right before that massive run to $49. The relative strength index is showing silver is not overbought. There's plenty of room to run higher. And the volume patterns suggest that smart money has been accumulating on every dip. Now, let's talk about what a gap up actually means and why it's significant. A gap up occurs when the opening price on Monday is significantly higher than Friday's closing price. This happens when there's news or developments over the weekend that cause a fundamental reassessment of value. In silver's case, it could be a major geopolitical event, a surprise announcement from a central bank, a major industrial buyer announcing a large purchase, or simply the market finally acknowledging the supply deficit that's been building. When silver gaps up, it's not just about the immediate price move, it's about the psychological shift that occurs. Traders who have been short silver suddenly face losses and have to cover their positions, which means buying silver, which pushes the price higher. Investors who have been sitting on the sidelines suddenly experience FOMO, fear of missing out, and rush to get in, adding more buying pressure. It becomes a self-reinforcing cycle that can push prices much higher in a very short period of time. I want to share a story with you about what happened to a friend of mine during the 2011 silver run. He was a professional trader, very experienced, and he had a short position in silver. He was convinced that silver at $35 was overvalued and was betting on a pullback. But instead of pulling back, silver kept grinding higher, $36, $37, $38. He kept adding to his short position, convinced he was right. Then one Monday morning, silver gapped up from $39 to $42 on the open. His losses were so severe that he had to close his position at a massive loss. Within 2 weeks, silver was at $49, and he had missed not only the opportunity to profit, but had taken a significant hit to his trading account. The lesson there isn't about being short or long. It's about recognizing when the market is telling you something fundamental has changed, and right now the silver market is screaming that something fundamental has changed. The question isn't if silver is going higher, it's how fast and how far. Let's talk about some specific price targets because I think it's important to have a framework for understanding where this could go. In the near term, the first major resistance level is around $35. That's where silver topped out earlier this year before pulling back. If we gap up through that level, the next target is $40, which is a major psychological level and also represents the highs from 2020. But here's the thing. If silver breaks through $40 with conviction, there's not a lot of resistance until you get to that $49 level from 2011. Now, could silver actually take out the 2011 highs? Absolutely. In fact, I think it's more likely than not over the next 12 to 18 months. Why? Because the fundamentals today are stronger than they were in 2011. The supply deficit is larger. Industrial demand is higher. The monetary backdrop is more favorable. And perhaps most importantly, there's been over a decade of underinvestment in silver mining, which means supply is going to struggle to keep up with demand even if prices rise significantly. Some analysts are calling for $60 to $70 silver within the next 2 years. The most bullish forecasts I've seen are calling for $100 silver by 2026. Are those numbers realistic? Well, consider this. If silver just returns to its inflation-adjusted high from 1980, we're talking about silver over $150 an ounce in today's dollars. Now, I'm not saying we're going to $150, but it puts into perspective just how undervalued silver is relative to its historical peaks. But let's bring this back to Monday and what you need to be watching for. If we do get a gap up, here's what I'll be looking at to confirm this is the real deal and not just a head fake. First, I want to see strong volume. A gap up on light volume can easily be reversed, but a gap up on heavy volume, especially if it's accompanied by news of physical shortages or major buying, that's much more sustainable. Second, I want to see the mining stocks confirm the move. Silver mining stocks typically leverage the moves in silver by a factor of 2 or 3 to 1. If silver gaps up 5%, I want to see the major silver miners up 10% to 15%. If the miners are lagging, it suggests the market doesn't believe the move is sustainable. Third, I want to see gold moving higher as well. Silver and gold tend to move together, with silver being more volatile. If gold is weak while silver is gapping up, that's a red flag. But if both metals are moving higher together, that confirms we're seeing a broad-based move in precious metals driven by fundamental factors. Now, I know some of you are wondering about the risks. What could go wrong? What could prevent this gap up from happening or cause it to reverse? Let me be honest with you. There are always risks. The Fed could surprise everyone with a hawkish stance that strengthens the dollar and pressures commodities. We could see a major deflationary event that causes investors to flee to cash. There could be a major margin call event that forces leveraged players to liquidate positions across the board, including silver. But here's what I think about risk in the current environment. The biggest risk isn't that silver goes down from here. It's that you miss the move up. Think about it this way. If silver drops back to $25, which would be a significant decline, you're talking about a 17% loss from current levels. But if silver goes to $50, which I think is very possible over the next year, you're talking about a 67% gain. The risk-reward ratio is heavily skewed to the upside. And here's something else to consider. Silver is one of the few assets that serves as both an inflation hedge and a deflation hedge. In an inflationary environment, silver rises because it's a tangible asset with intrinsic value. In a deflationary environment, silver can still rise because it's a monetary metal that benefits from safe haven flows. The only environment where silver really struggles is a strong, stable economy with rising real interest rates. And that's not the environment we're in or likely to be in anytime soon. Let me share another historical parallel that I think is relevant. In 2008, during the financial crisis, silver initially crashed along with everything else. It went from $20 down to $9 in a matter of months. But then something interesting happened. As central banks around the world responded with massive monetary stimulus, silver didn't just recover, it went on to triple in price over the next 3 years. We're in a similar situation now. We've had massive monetary stimulus in response to the pandemic, and we're likely to see more stimulus as economic conditions weaken. That's rocket fuel for silver. The other thing that's different now compared to previous cycles is the level of awareness about precious metals among younger investors. Millennials and Gen Z, who have grown up in an era of financial instability and currency debasement, are much more open to alternative stores of value than previous generations. They're buying silver not just as an investment, but as a form of financial insurance. And as this demographic cohort enters their peak earning and saving years, that demand is only going to increase. There's also the geopolitical dimension to consider. We're living in an increasingly multipolar world where the dominance of the US dollar is being challenged. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to create alternative payment systems and reduce their dependence on the dollar. While a lot of the focus has been on gold in this context, silver plays a role too, especially as these countries industrialize and need silver for manufacturing and technology. Russia, for example, has been accumulating silver reserves. China has been building strategic stockpiles of silver for years. These aren't short-term trades. These are long-term strategic positions based on the understanding that silver is a critical resource for the 21st century economy. When governments start hoarding a commodity, that's usually a pretty good signal that the commodity is undervalued. Now, let's talk about what you should actually do with this information. I'm not going to tell you to go out and put your entire portfolio into silver. That would be irresponsible. But I do think having exposure to silver, whether through physical metal, mining stocks, or ETFs, makes sense for most investors right now. The exact allocation depends on your individual circumstances, risk tolerance, and investment timeline. If you're someone who believes in holding physical metal, now is the time to be buying, even with the premiums. Yes, you're paying more than spot price, but if spot price gaps up significantly, those premiums become irrelevant, and there's something to be said for having physical silver in your possession. It's real, it's tangible, and it's no one else's liability. If you prefer the liquidity and convenience of paper silver, the major silver ETFs like SLV or PSLV are options, though be aware that these come with their own risks and considerations. Mining stocks offer leverage to the silver price, but also come with company-specific risks. A diversified approach that includes some physical, some ETFs, and some quality mining stocks probably makes the most sense for most people. But here's the key point I want to leave you with. We are at an inflection point in the silver market. The conditions that have kept silver suppressed for years are breaking down. The supply deficit is real and growing. Industrial demand is accelerating. Investment demand is returning. The big players are positioned for higher prices, and the technical setup suggests we're on the verge of a major breakout. Monday could be the day that breakout begins. It might not be. Markets don't always move on our timeline. But whether it's Monday, next week, or next month, the move is coming. The fundamentals are too strong, the supply situation is too tight, and the monetary backdrop is too favorable for silver to stay at these levels. This is one of those rare moments in markets where everything aligns: the fundamentals, the technicals, the sentiment, and the positioning. These moments don't come along often, and when they do, they create life-changing opportunities for those who recognize them and act on them. The 2011 silver run created fortunes for those who were positioned ahead of it. The question is, will you be positioned for what's coming next? Watch the market closely on Monday. Watch for that gap up. Watch for the volume. Watch for the confirmation from the mining stocks. And most importantly, make sure you're positioned to benefit from what could be one of the most significant moves in the silver market we've seen in over a decade. Because when silver moves, it moves fast. And if you're not already in, you'll be chasing it all the way up.